And this week we've got James Henderson and Laura Foll, the managers of Lowland Investment Trusts, amongst others, to talk to. So it should be quite interesting to hear what they have to say about UK equity income. I've got a few little bits of news to do. One of the things that we've been bad at is not putting these property disclaimers on the front. So I should highlight these, and they should now be all over the place. But the key message here, which I won't go into every week, is basically to say that this is not intended to get you to buy anything that we talk about here. It's just to sort of spur some thought and encourage you to think about it. So let's get going. This week, not a lot of news actually on the investment company front. Nothing particularly exciting anyway. So one thing I wanted to talk about was BioPharma Credit, because it's just activated a discount control mechanism, which is a slightly unusual version of one of these. And then I'm going to, just to sort of broaden out a bit, bring in our property analyst, Richard Williams. He's been working with us for about a year now. So a couple of things we want to talk about there. So one is the UK office market, because one of the funds that we cover has just sold its last office investment in London. And what does that kind of mean for the office market? And the other thing news this morning is that the big shopping centre company Intu looks set to be going to administration, having been really quite a big company at one point. So that's what we'll cover, and then we'll talk to Lowland. So BioPharma Credit first. As you can see here, it's in the sort of direct lending sector of the investment company's arena. Within that, there are all sorts of things, making all sorts of different kind of loans. It's quite unique because it's lending to biotech companies. And you also see here that it's actually trading on one of the tightest discounts. So it might seem strange that it's activated a discount control mechanism. But it is, I think, quite important that these things trade a bit like bonds. That was the idea of them when they came in. And therefore, you'd hope that they really wouldn't have very big discounts at all. Obviously, the problem we've got is that you're seeing actual defaults on some of these. And some of these have just given up and they're just going to wind up and give the money back. And you've seen, I suppose, the fear of prospective defaults in a whole load of different loan funds as well, because of what's going on with COVID-19. Fortunately, though, BioPharma Credit should be not much affected. So here's the returns. So you can see that the NAV returns have been actually quite fine. I've blanked out the returns on VPC specialty lending here because Morningstar's got a mistake on those at the moment. One of our perennial things we have to do is to keep them in line with in terms of the data that they provide us. But you can see that actually the returns of BioPharma Credit are actually quite respectable. Here's the charts. The NAV total return is the purple one, and the price in pink, and you can see how that's gets out of it as the discounts emerge. It actually did go to move to trading at quite a big premium to sell off with, as we'll see later on. It's funding life sciences companies, and this is obviously a very specialist area. And because it's a very specialist area, it means that the underwriting of the loans is quite complex too. And they're certainly sort of a narrow field of people who can comfortably do that. So a normal bank would feel very uncomfortable. They can use it for loans, for example. Because there's less competition, that means they get higher rates. And so this is why they think they can make loans at quite attractive yields without compromising too much on risk. It's quite an experienced team. They had funds before they launched BioPharma, targeting 8-9% annual returns and a 7% yield on the issue price. So really quite cool. And one of the things that I was slightly wary of when it launched was that it was not very well diversified. So it raised a huge amount of cash and actually kept issuing stock, so it expanded a few times as well. It had a pre-existing portfolio that it could invest in. So you can see that they're the yellow and lighter blue numbers here in the IPO column, but a huge amount of cash at the beginning. And then it started to deploy that. And one of the first things it invested in was a loan to a company called Desaro, which is the grey one you can see here and here. And that was an interesting investment, but one of the things I was worried about was just the concentration of risk in the fund. And even back in 2018, you can see that Desaro was still a huge chunk of the portfolio. Fortunately, I suppose, for BioPharma, but well, it's a problem and an opportunity. Desaro got taken over by Glaxo, and that meant that the loan got repaid early. So they got a huge chunk of money back. They earned extra interest because of sort of prepayment penalties built into the loan structure, but they had to deploy that. But the upshot of that is roll forward another year, and actually we've got a much more diversified portfolio. So they still got a fair chunk of cash. There's no gearing associated with this. But the biggest investment now is this Sarepta thing here, which I think it's probably easy if I explain what that does, and then explains kind of what BioPharma's looking at. So Sarepta makes a couple of drugs aimed at treating Duchenne muscular dystrophy. The way that the muscular dystrophy works is there's a problem with the gene that makes dystrophin, which is something involved in how muscles work. And so they think they've got drugs that can help replicate what their dystrophin would have done, and that helps treat the problem. So two big drugs. You can see down here from the pipeline of sales that they estimate that this drug is just one of these drugs is going to get. Very rapidly, the loan, which they're talking about up to $500 million, is going to be way covered just by annual cash flow. So you can see how there's gamble's the wrong word, but there's a sort of a risk at the beginning that if suddenly this thing got pulled, there'd be a problem trying to cover the loan. But obviously we haven't lent the whole $500 million yet. And then as the sales ramp up, then they can draw down more money, but it should all be quite well covered. And for that, BioPharma Credit gets an 8.5% coupon, and then these extra chunks that it gets make quite a big difference to its income as well. So it takes another 1.75 when the money is drawn down by the borrower, and then it gets another 2% if it's prepaid early. Even better than that, or when it's repaid at all, sorry. If it's prepaid early, which is this thing down the bottom here, they get whatever they would have earned in the first 2 years. So if it got repaid tomorrow, they get all of the interest they would have earned for 2 years. Plus, they get an extra 2% if it's repaid before the 10th anniversary. So that's really quite chunky income, and that's why this thing makes so much money. But you can see the kind of risk involved is the risk around, is this drug any good? Will something come along to replace it? Will it have to get pulled because of the unexpected side effects? But obviously, that's where they're doing all the analysis to try and make sure it doesn't happen. So it traded a decent premium for much of its life. This is the whole history of the fund until very recently, and it's just the normal sell-off that occurred with the COVID stuff. Everybody seemed to panic at the same time. Everything sold off together. But the share price hasn't quite made it back to asset value. And it's got this discount control mechanism that basically says, as it says there, if the shares trade at 5% on average over 3 months, then, provided it's paying out its 7% dividend, it's going to use half of the money and income that it gets back from in loans to buy back shares until the discount averages at 1% for a 2-week period. That's quite an aggressive discount control mechanism, but actually I think quite a cool one. Because obviously they're first protecting the dividend income, and then after that they're just really throwing everything at the problem to try and tackle the discount. And I quite like that, so it's me ticking box for me, BioPharma Credit. So that's that. Now let's talk about property. I'm going to first unmute Richard. There we are. There we go. Hi, Richard. Good morning.
Hi. Thanks, Jay.
So we're going to talk a bit about UK commercial property and what it's doing in offices in London, please.
Yeah. So the UK commercial property REIT sold the last remaining City of London office this week. That's Elgin House. Sold for 40 million, which is 3.6% below its March valuation. But they'll say they sold it because it was at the natural end of its property life cycle. They acquired it in 2015, carried out refurbishment and let up all the vacant space and re-geared the leases, and that's the cycle that they do. They take on asset management projects, take them through to full occupancy, and then sell them on. So the timing for them couldn't have been better, really, to sell this in the current market. It's down on valuation, but not too bad. And given the cloud that's over the office sector at the moment, it's a pretty good time for them to come out. As you see on this slide, the COVID-19 impact has been huge for the office sector. Everyone working from home. Corporates have put on hold their office move requirements and are now even sort of assessing their space requirements going into the future, with people sort of blending, coming into the office and working from home. Do they need that amount of space? And the stats that I've seen so far for the take up in Q2 is 88% down on the same period last year. So that is all due to the impact of COVID-19, but there'll be trends that are long lasting following this. The obvious one, if you see on the next slide, the obvious one being that people will work from home a lot more now. So the smaller office space requirements. We saw this week that the London Mayor Sadiq Khan said that he's relocating City Hall to the east of London, much smaller office. So that shows that, assuming there's no job cuts, that shows that they're planning to have a lot more of their employees working from home. A host of banks as well are assessing the size of their HQs. But moving forward, I could see a lot more corporate head offices in London being smaller. There's also been talk of a hub and spoke model or satellite offices, whereby they have their HQ in the centre of London, but have offices or an office around London, so employees don't have to get onto busy and packed trains and things like that. Which there has been a couple of examples of that, of companies looking at offices around London in the home counties and stuff. I think Santander said they were looking at one. And that's an obvious benefit for the occupier, because obviously rents are cheaper in the southeast compared to London, up to about 60% cheaper. So if they can cut their HQ in London and have a second office in the surroundings of London at 60% cheaper, then that could be a trend that sticks. And also that, although you see the headlines with WeWork and like that, there could be an increased demand for service offices going forward, due to the fact that companies can flex their space up and down when they need it, when they don't need it, and to do that, service offices are the perfect place because they're short contracts, and they can come out, go into them when they need. So that could be a trend going into the future. What does this all mean for property companies then that are big in London offices. Well, as you can see on the next slide, this is the share prices of 3 London-focused property companies, Derwent London, Great Portland, and Helical. And you can see that what the market thinks already. The share price has come off since COVID-19 and hasn't come back. So there's definite concerns around the market. In the short term, there's going to be reduced demand for space, which will mean falling rents and falling capital values. In the long term, the jury's still out, but as I said earlier, we're probably going to see less space requirements, which will mean oversupply and a realignment of rents downwards, which we've seen happen in the retail sector in these last few years, which leads me on to the news of Intu today. So they've announced today that they're likely to fall into administration today, having not been able to come to any agreement with their creditors. I mean, the writing has been on the wall for Intu for months, and it's just been accelerated by COVID-19. Their debt pile was huge. They piled on the debt during the retail heyday of the sort of 2010s, and failed to see the e-commerce boom coming. It's got £4.5 billion of debt, which you could say was manageable when their portfolio was worth 10 billion, as it was, but those values have been plummeting in recent years. Their last valuation was 6.6 billion, giving it a sort of a loan to value of about 68%. So they obviously breached several of their debt covenants and have been sort of at the mercy of the banks ever since. They tried an emergency cash call earlier this year of about 1.5 billion, which failed. They've been trying to negotiate waivers with the banks and standstills, and that's finally come to an end today, or is likely to. It means if they do go into administration, which they said today is likely, it'll mean the administrator's taken over the running of the malls, and will probably result in the fire sale of assets, likely at discounted values. And I mean, that's another hammer blow for the shopping centre sector, with values already plummeting. If they start selling assets at big discounts, that would have a massive impact on other shopping centre owners and the sector more widely. It's important to stress that that Intu's problems were all self-made. Like I said, they piled on the debt, and this was going to be a likely outcome if we had COVID-19 or not. This would just accelerate the process. Property companies that have a conservative debt level, which the majority do in the listed property sector, that I think they're in a good place to ride out this storm, as and when we sort of get back to normality on rent collections, and collecting in the deferred rent that they've agreed over the past few months. Those with low debt levels should be able to ride out the storm. So I don't see a wider number of companies failing due to COVID-19. It will just mean rents will be pushed on into sort of next year.
Okay, cool. There's actually, just quickly, there's a couple of questions popped up on this. So one of them says, it just says, will office spaces simply become meeting areas and hot desks rather than daily workspaces?
I don't think so. I don't know about you, but I think the office as a place for sort of creativity and collaboration and things like that, it's definitely still will definitely be a trend going forward. I think more likely, like I said earlier, with the serviced office space, that there could be a pickup in demand for that, because like the question said, people may strip out their sort of meeting spaces and things like that in their head offices and just use sort of serviced offices as and when for contract work or things like that. When they need to scale up the business or scale down the business, they can get rid of it quickly instead of being tied into a sort of 10-year lease on their headquarters. They can get rid of the serviced office quickly. So I think that might be a trend that picks up going forward.
Okay, cool. And then the other two are really around what alternative use do offices have? I suppose the obvious one is residential.
Yeah, they're obviously, most of them are pretty central, especially London. Central London offices would have a huge alternative use value for residential. We're seeing that quite a lot with retail as well, more in the sort of retail parks and retail warehouses, sort of on the edge of towns. Their alternative use values are coming for residential, and also logistics are becoming really prominent at the moment, just because of their location. So yeah, I could see that becoming more of a trend as well.
Cool. All right. Thanks very much for that.
Thank you.
We shall hear more from you in future weeks. So let's now talk to our Lowland managers. Let's make sure they can talk first.
James?
Hello.
Hello, James.
And Laura?
Yeah. Can you hear me all right?
Yes, thank you. Very good. Well, thanks very much for coming on. So I think we'll just sort of gentle introduction first off. Do you want to sort of just give us a brief bit of history of Lowland, and because it's not one of the oldest investment trusts that you manage, and it's interesting, I think. Do you want to say something about that, James?
Yes, I've managed it since 1990. It started in the 1960s. At Henderson's, interestingly, in the early days, it was always given to a young manager. I suppose I've kept going for rather too long, but Laura is working with me. It was always given to a young manager because income funds had a discipline. You bought things when they were out of fashion and good value, and you sold them when yields fell, because the company had become fashionable, was become highly rated. And that was always thought to be a good discipline. And for much of my career, it has been a good discipline. It hasn't been a good discipline for the last 5 years, where the higher rated stocks have gone on up, and it's been much more challenging finding stocks in the yield sector with out of favoured stocks. We've always run a long list of stocks. It's always been about large, medium and small companies. Over time, the small companies have actually given very good returns, but they've done it in a volatile manner. They've had periods when they've been in favour, and they've had periods when they've been out of favour, particularly the yielding type of small company. These are often a bit more cyclical than other companies, and those companies in the downturn do suffer, but they look at themselves, they get focused on their costs, and they recover well. And Lowland has traditionally performed well coming out of down cycles, but at the moment we are suffering in the UK with the UK-centric nature of the portfolio, but we are finding opportunities.
Yeah, I can remember periods when Lowland's been one of the best performing funds, definitely.
Yes.
As you say, yeah, not so much recently. I suppose, the reason why it's so fascinating to talk to you at the moment is because everybody's wondering about income. We've seen bond yields falling again, interest rates are 0, and lots of big companies have cut their dividends. So it's how do you actually navigate through that scenario? It does seem like investment companies are doing much better, but do you want to say something about how you're actually coping with Lowland?
Well, it is great running an investment trust in these situations because you have got that revenue reserve, and we are looking through the next period thinking, will the actual earnings recover to the dividend? And perhaps, Laura, you give some colour to that.
Sure. So, I mean, to put it in a bit of context, this year consensus has dividends for the UK market down about 35%. So that's materially worse than the financial crisis. I think what's becoming clearer now is what sectors won't be paying. So we now have a pretty good idea of what companies will and won't pay dividends. But the bigger question, the next question effectively is when dividends come back and at what pace they come back. And that's really where there's a bit of a debate in the market at the moment, with some people thinking that dividends will fall again next year and analyst consensus having it as dividends rising about 20%. We think the latter, that dividends will recover at least to a degree next year. For a couple of reasons, some companies that we own, like RSA, have been very public about their desire to get back to paying a dividend. Privately, some other companies like Direct Line have said the same. And then also some companies like the banks have been explicitly barred from paying a dividend this calendar year, but might return to the list in some sense next year. So we think the dividends will recover a little bit in 2021, but not to 2019 levels. I think the way we've always managed Lowland is that income is an output. So focus on growing the capital and always see income as coming from that capital growth. And so ultimately the dividend decision of future dividends for Lowland will come down to what we think is best for capital growth. Because what we're finding at the moment is that in our view, the best total return opportunities are in those companies that tend to have suspended their dividends. Not exclusively, but just generally, we're finding the best opportunities in those areas. Because what we're finding is that those companies that are still paying a dividend, things like utility companies or pharmaceutical companies, for want of a better word, they're very picked over by income funds because there's so few companies. Well, there's such a narrow area of the market now that is still paying a dividend that we think that the more sort of undervalued, overlooked area of the market at the moment is those that aren't paying a dividend, which is quite difficult for an income fund manager to say. But I think that is where we're finding the best total return opportunity at the moment.
So I think the yield on Lowland now is about 6%. Is that right?
Yeah, that's right. Yeah, if we paid 60p.
It's almost really about it. So obviously you've got the reserves on it. Well, actually, how much have you got in revenue reserves? What sort of?
Yeah. So basically, as the financial year ended September, and then we had 18.4 million, which is about 68p per share. We've got to be a bit careful with that number because it's before paying out the third. So we pay quarterly dividends, and that number is before paying the third interim dividend and the final. So the true revenue reserve number is more like low 50s pence per share compared to a dividend that we paid last year of 59.5p. So say we paid 60p this year, we've got about 80% odd of a year sat in the reserve. We've added to that a lot since the financial crisis. We've added about 11 million since the financial crisis and not used it at all since 2010. So I think that ultimately that revenue reserve is shareholders' money that we haven't distributed. And we're well aware that as an investment trust, as James mentioned, we're in a lot stronger position than an open-ended fund would be. And for anyone that's got 5 minutes, we've recently put out our half-year report. And basically what the chairman said in his statement is that it's our firm intention to maintain the dividend policy if possible. And by if possible, what we're trying to get across is if it's in the best interest of shareholders. Can we continue with the investment policy that we think will generate the best total return while still paying that dividend?
What's your view on paying dividends out of capital as a sort of general rule? Because obviously there are some funds that do that. Do you much prefer to actually earn the income you distribute?
Yes, definitely. We would prefer it to become from income. We don't want to chip away at the capital. Going back to that point Laura was making. Everything we're buying because we're wanting to grow the capital. And in the end, real good sustainable income comes from growing the capital, having a bigger pool of capital. So the zero yielders we're buying, I'm hoping that a lot of them will come back onto the dividend list in 2022, and actually you'll see the earnings recover when those come back onto the dividend list. I think it would be a board decision, but I think I can firmly say that I would be, if the advice, if they asked me for my advice on it, would not to pay it out of capital. Income is there as a product of capital, and grow the capital would be what I'd want to do. That's the way to get out of the problem.
Sure. Okay, that makes sense to me. One of the things, obviously, this is not the first time that we've seen a big hole in UK equity income. I can remember the BP Deepwater Horizon dividend cut, and going back to the 90s, and Midland Bank passing its dividend, and so these things do happen from time to time. Are there constraints involved in running a pure UK equity income fund that bind your hands too much?
I think it was. Sorry, James.
I think for me, the length of the list and being in medium and smaller companies gets around that problem. There are going to be, the UK economy is in a difficult place at the moment, but there will, out of this slowdown, emerge some really good smaller companies. It's our job to find those smaller companies, and that means running a relatively long list. Some companies will recover, they will reinvent themselves in this difficult time and come back as bigger and stronger companies. So for me, I agree, if you were running just big companies, you are limited into a narrow range of stocks. But we will find companies on AIM. Some of our best investments in recent years have come from AIM type companies. Johnson Service Group is a company that has been a big success over the years. Churchill China, again, a family controlled company when first bought on a good yield. The family members always like to get a dividend. And it has been a very successful and grown from the UK. It's now operating successfully internationally, selling internationally. It's that kind of business that can give you the variety, the diversity, away from just simply the big stocks. Would you like to add to that, Laura?
Yeah, no, I think that's right. And if you went back and looked historically at the payout ratios, the dividend payout ratios, if you looked at the FTSE 250 and FTSE small cap, it never quite got to the high payout ratio that the FTSE 100 did. So I think what you've seen going into the crisis is that small and medium-sized companies have been quicker to cut their dividends. As James said, they're generally more cyclical. They don't often have the same balance sheet reserves as some of their larger cap peers. But what I think you might see is that they're quicker to restore the dividends to the level they were before. This isn't the case universally, I'm generalising, but generally they didn't get to that. The FTSE 100 was at a 60 to 70% payout ratio going into all of this. FTSE 250 and below never got to that point. So I think you will see the dividends hopefully restored quicker at that smaller cap end. And I'm really glad that, so for Lowland, to give you a bit of context, we explicitly say in the investment objective that we won't normally have more than half in the FTSE 100. And I think that breadth is really important at the moment in terms of giving us the choice of dividends across the market. Because if you were just restricted to the FTSE 100, the list of dividend payers is pretty narrow now.
Yeah, exactly. And I think what you're doing it does definitely make sense to me. And we should sort of maybe just dive straight into questions, because there's some coming through now that sort of make sense to what I was going to ask about now. So let's do first. So what happened in the sell-off in February, March? Were you trading much then?
Yes, we weren't net investors, but what we were doing is adding to quite a few of the weaker names on what looked like, so far to be good levels. So Lowland has quite a high weighting in industrials and financials. It has done for a long time. We took the opportunity to add to quite a few of our industrial names at really quite low valuations versus history of it's hard to know what the PE will be this year because we don't really know what the E is going to be. But if you use historic measures like EV sales for businesses where we don't think they're structurally impaired, we were buying in really March, sort of mid-March onwards at what looks to us to be pretty attractive levels. And the same with some of the financials. We added to some of our insurance names. We took a new position in RSA, and we added to the position in Aviva. Harking back to the dividend point, these are ones that both RSA and Aviva have suspended their dividends, but we think they'll return to the list fairly quickly. And when they do, we think the yields that we're buying these companies at will look really attractive.
I mean, the sort of sector tilt in the portfolios, does that just come out of the stocks that you see that are attractive, or is there any kind of deliberate bias involved?
We're looking for overall blend of risk in the portfolio. So we want diversity. But no, the sectors, we don't think today we're going to have 10% in insurance. We're looking for opportunities across the insurance sector, across the market, and we at the moment we found quite a few in the insurance area. The same with industrials. The industrials cover a lot of very different companies. The industrial weighting is really the result of lots of individual stock decisions in a lot of a lot of different end markets are featured in those companies. So no, we're not sector driven. But we are after blend. We like blend of risk. So it's different end markets matter rather than strict sector disciplines.
Cool. Okay, that makes sense. And what do you do about the gearing? Have you adjust that from time to time of what's happened the last few months?
So on a percentage, sorry, John.
No, you go, Clara.
On a percentage basis, the gearing hasn't changed too much. So today it's between 13 to 14%, which if you went back over the last 10 years or so, it would be about mid-teens on average gearing. So it's not too different. On a pounds-pence basis, we've taken a small amount out of the gearing year to date. It's pretty minor in the scheme of things. And where we've done that, we've tended to reduce names that have been historically good performers for the portfolio. So to give you an example, we've held a position in Avon Rubber for a very long time, and it does defence equipment. It's acted defensively. It's been a good performer. We've just reduced that a little bit in order to rotate into those, the RSAs, the Avivas that I mentioned.
Do any of the sort of more defensive things look expensive to you now?
Yes, some of them would. I mean, Avon is undoubtedly a good company, very well managed, and it did a deal. They bought a business from 3M that looked a very good deal. But where the rating is now, I think it's fair to say, James, we're both probably a bit surprised by the rating that it's got to, especially given the scale of the company. I think what it's effectively doing is pricing in another deal. So yeah, there are a few of the defensive names, but what we're doing is just going slowly when it comes to reducing them, because what we've found in the last few years is that we tend to reduce quite early because of the valuation discipline that we've got. Where we've made some mistakes in the last few years is reducing names like that too quickly. So we're trying to counteract that and just go slowly where we are reducing them.
Avon is interesting. You're going back to your saying that the limited number of opportunities. It came in as a yield stock. People say you can never get technology in the UK. Actually, what differentiates something like Avon and has led to its success is its masks. And they do have a technology, not a technology in the sense that you get in computing, but they make a better mask. The filters work better. That's how they've sold over the years, and it was their development over many years of producing masks that gives them the edge. So technology in its broad sense can be found in the income sector, and the best companies always have some sort of edge, and it usually comes with technology in its broadest sense. It's now a highly rated company, and that's why we slowly reduce to recycle into hopefully another company like that in time that has got some real good edge, and that will come out over the years with increased sales and increased margins. And the UK will have stocks like that in this downturn. They're there. We just have to work hard to find them at the moment.
Do you think the UK market looks particularly cheap relative to global markets?
I do. It's underperformed very markedly. There are serious issues in the economy. There's a lot of uncertainty, but in the end, you're not buying the economy with the UK stocks. You're buying individual companies with individual management teams that will find a way through. The good ones will find a way through, and actually, you're buying them on ratings I've not seen since I started managing Lowland in 1990, and the normalised dividend yields they're on, I think, is also higher than I've ever known them before. By normalised, I mean when we get through the current volatility in dividends.
Exciting times then. I mean, actually, these two things are linked together. I've got one on the, but I suppose people are just keen to know what else you've been buying. I suppose. I've got a question here about what else you've been selling. So, any of the kind of portfolio news you want to talk about?
Shall I start, and then you can pick a few that you like? If you look at some of the areas that we've been adding to aside from insurance, this harks back to what your property analyst was saying. We've actually been adding a small amount to land securities. We did already hold it, but we've added to it quite materially over the last few months. It's both retail and offices, but it's trading at about a 55% discount to its NAV. And bear in mind that NAV has already been brought down quite markedly. So one way of looking at it is you could almost say the retail or near enough zero. And this is quite prime retail assets. You know, it seems like one new change in St Paul's, which is basically restaurants and cafes anyway, rather than traditional kind of clothing retail. And the office assets, but it has a pretty prime office assets. I slightly disagree with your analyst. I think the sort of the debt of offices is a bit overdone. And something like land securities has been such a poor performer and went into this with a pretty strong balance sheet. It's one of these ones that has suspended its dividends. But to James's point, I think once it returns to paying, the dividend yield that we'll be buying it at now will look really quite attractive. So that's one area. And in the smaller company area, there are a few names that we've added to and a few new names. So something like Ricardo is one that we've added to. It's been very weak year to date. For those that don't know it, it's a consultancy business. It does environmental consultancy. So say you're a company that wants to reduce their water usage, for example, or bring down their carbon emissions. It also consults to the auto industry though, and that's why it's been such a poor performer year to date. Historically, its original business was auto consulting, and people still think that that's the majority of the business. It's not really anymore, but it's got that legacy kind of perception on it. That's one that has been a very poor performer. We think it's a bit overdone. I don't think it needs an equity raise, but I think that's what the shares are suggesting. So we've added a small amount to that one as well. Do you want to pick any particular ones, James?
It is at these times really the emphasis has to be on very good management, particularly management that has perhaps been in the business for a few years, not too long, a few years. They've really got to grips with the business and can utilize this difficult period. A company I would highlight like that would be Morgan Advanced. I think the newish team there are doing a very good job, and I think the success that they will come to them when the economy improves. I think they'll be very well placed to grow both their dividends and their earnings well further out. And newish holding for the fund is ready. And it again, the management team, it's a difficult time, difficult industry, but a really good management team should take them forward. So it's a relatively long list. Some of these companies won't recover as we think they will, but that's why we need a relatively long list. And some will recover and go considerably from here. I think it's so important is management quality, rather than worrying too much about what industry it is. Good management will be found in lots of different industries.
Oh, I think that's a good maxim to live by. Thanks very much for that. I mean, there's some other little questions, but we'll probably answer those separately. So thank you very much, both. That's very interesting. And obviously, if you want to go and read the interim accounts, they're on the James Henderson website. So that's all from us for this week. And next week, we're back with Paul Niven from F&C. And I'll have a co-host who's Andrew McHattie, but that'll be all explained in the email that goes out with the invite. So thank you, James. Thank you, Laura. And thank you for everybody that listened in. And if you've got any other questions, just email me. Thanks very much.
Thank you, James.
Thanks, James.
Thank you very much, James.
Cheers.